Nano-X Imaging, ticker NNNO, just gave us the medtech paradox of Q4 2025. A little more revenue, a lot more pain, and as of 2026-0420, the market is calling it a reality check. This is earnings unscripted, and there is quite a lot going on here.
Yeah, tiny top line, enormous story. Revenue was $3.7 million, up from $3.4 last quarter. But diluted EPS was negative 50 cents versus negative 21 cents. Operating loss blew out to $35.4 million from $14.2, and GAAP gross margin was roughly minus 97%. So the headline is not growth. It's cost structure and accounting pain.
Right, and this wasn't just some ordinary ugly quarter. A huge chunk of that pain came from them basically admitting, okay, the in-house chip plan isn't worth it anymore.
Exactly. $17.5 million impairment, mostly non-cash, because they're shutting the South Korean fabrication line and moving chip supply to CESM in Switzerland. We don't have a clean consensus estimate in front of us, but honestly, the market wasn't trading some tiny beat or miss on revenue. It was trading that loss profile and the pushed-out timeline.
And the tape was brutal. On the earnings event, not the whole quarter, the stock got hit about 24%, and that pre-market slide basically turned into a full gap down when the regular session opened.
Which tells you people saw this as, fine, the strategy may be getting more rational, but it's taking longer and costing more. For anyone who doesn't live in imaging land, Nano-X is trying to sell lower-cost 3D digital tomosynthesis systems, the Nano-X.ARC, while also running teleradiology and now a small AI and health IT business. So it's really three businesses awkwardly sharing one ticker.
Also, quick legal housekeeping. This is not financial advice, just our opinions and a dangerous amount of curiosity.
Fair enough. And the segment mix is the whole thing here. Teleradiology was the steady part at about $3.1 million. AI and software jumped to $500,000 from $142, mostly because they bought Vaso Health IT in November and got about $400,000 of revenue almost immediately. But imaging systems and OEM revenue was $49,000, not $49 million, obviously, $49,000. So the imaging dream is still mostly a dream in revenue terms.
That contrast is kind of the episode, isn't it? Because tucked inside all this, they also had that very human anecdote about their first ARC installed in a live emergency department in Israel. And that lands. An ER is not a concept. It's people rushing around, somebody in pain, a clinician needing an image now.
Yeah, that part is real. Same with the Cedars-Sinai work, where their AI reportedly found 6 hidden cases of severe aortic valve calcification in retrospective scans. Those moments explain why the story hasn't died. There is something potentially useful here. But then you snap back to the quarter, and the actual hardware commercialization is crawling.
So when management talks about a fundamental shift and then signs that Howard deal for 300 systems, I kind of want to believe it, but then I hear them say also, don't expect a big Q1 ramp, which is not exactly chest thumping.
No, it's actually the opposite. It's level setting. They kept the full year 2026 target of $35 million in revenue, but the CFO was pretty clear that the meaningful ramp, if it happens, is more second half of 2026. And the reasons are boring but important. Regulatory limits, construction, imports, training, all the stuff that slows medical rollouts. Great press release velocity does not equal install velocity.
And cash only looked a bit better because they raised equity, right? Up to $60 million, but with more shares out.
Exactly. Cash and investments rose to $60 million from $55.5, but they sold roughly 4.2 million shares for about $15.5 million net. So yes, more cash. No, not because the core business suddenly turned a corner. That's a very different feeling.
I did appreciate the CEO's honesty on the Korean fab, though. It was basically, we built this during the COVID chip panic, and now it makes no economic sense, which is painfully relatable just on a much more expensive scale than the rest of us making a bad pandemic purchase.
Same psychology. Worse cap table. And weirdly, cutting that sunk cost may be one of the smartest things they've done. The question is whether outsourcing to Switzerland actually improves the unit economics fast enough, and whether the Vaso acquisition can buy them time by adding software revenue while the imaging rollout stays slow.
Yeah. Slightly more believable plan. Still very unforgiving numbers. All right, let's get into the details.
Yeah, and the first detail that matters is the impairment is not just some ugly accounting footnote. It's management admitting the original manufacturing plan broke. On the call, Erez Meltzer basically said, bear in mind that this fab was built during COVID when semiconductors were not necessarily available. Right now, we are rationalizing the situation. That is unusually plain language for a public company. It means the Korean fab was a crisis-era workaround, not a durable advantage.
Right, which is almost refreshing, honestly. It's like we panic bought a factory. Very expensive pandemic behavior.
Yes, same species as sourdough starter, slightly worse for shareholders. But seriously, the strategic point is important. Nano-X had been carrying this fantasy or maybe necessity that it needed to make a key component itself. Now they're saying no, better to outsource to CESM in Switzerland. In theory, that should lower ongoing operating burden and maybe help gross margins over time.
In theory, doing a lot of work there, though.
A lot, because the quarter also tells you how far they still have to go. Their gross profile is still terrible, and the hardware revenue base is so tiny that even if the supply chain gets more rational, you need actual system deployments before the economics can look normal. Otherwise, you just move the chairs around and the room is still empty.
Okay, so make that human for me. Is this like shutting your own kitchen and hiring a caterer because you finally realized you're running a restaurant with, 3 customers?
More or less, yes. And the worst version of that is you still don't know if customers will show up. The fab shutdown is probably the right choice. I don't think that's the controversial part. The controversial part is whether investors should treat it as the beginning of operational discipline or just another reset in a very long sequence of resets.
That's the trust question, isn't it? Because when an early stage company says, no, this delay is actually rationalization, the listener hears maybe, but also maybe you just ran out of good options.
Exactly. And there's another layer here. The teleradiology business is the only thing that currently behaves like a business. It throws off recurring revenue. It has customers. It doesn't need a heroic installation story. The hardware side still needs regulation, construction, imports, training, workflow adoption, all these little gates. Meltzer said introducing new technology of any kind into a medical environment is always a complex process. It requires alignment across clinical workflow, regulatory frameworks, and operational infrastructure. That sounds boring, but it's actually the whole movie.
Yes, because medical tech always dies in the boring places. Not in the demo, in procurement, hallway politics, building permits, people asking who's going to service the machine on weekends.
Precisely, which is why I think the more interesting deep dive angle is the revenue mix. Nano-X is pitching a future hardware ramp, but the quarter's immediate improvement came from things that are much easier to monetize now. Teleradiology held up, and the Vaso acquisition added revenue basically on contact.
That bit caught my ear too. Contribute from day one? And then, well, it did.
Yes. Meltzer literally said, we expect this business to contribute to revenue from day one. And it did, with about $400,000 in less than half a quarter. For a company this small, that matters. But I wouldn't dismiss it as just a tiny bolt-on. It changes the feel of the story. Instead of waiting entirely on ARC installations, they're trying to build this layered model where imaging, software, AI, and health IT feed one another.
So sort of building side streets while the main highway is still under construction.
That's a good way to put it, and maybe a necessary one, because if the hardware rollout is slow, they need adjacent revenue streams that keep the organization alive long enough to get there. The optimistic interpretation is smart platform building. The skeptical interpretation is they're buying time because the core commercialization curve is taking longer than expected.
Which, to be fair, can both be true.
They often are. Also, there was a subtle clue in expenses. Sales and marketing moved up, and management was pretty open that some of that was salaries, recruiting, and conference spend like RSNA. Rand Daniel basically indicated that if they keep showing up at those events, some of that spend is recurring. So there's this awkward tension. They need to invest to make the product visible, but every extra dollar of commercial muscle lands on a P&L that still doesn't have scale.
That's the medtech treadmill. You have to look credible before you are economically comfortable enough to afford looking credible.
Nicely said. And then you add the regulatory wrinkle. They're still dealing with adjunctive use limitations in the U.S., and management called removing that a key priority. That matters because adjunctive use is Basically, the market saying, nice technology, but not fully trusted as a standalone answer yet. In Israel, they've made progress there. In the U.S., not yet, so every bullish deployment forecast has this invisible asterisk next to it.
Which is probably why the second half 2026 ramp language matters so much. It's not just caution, it's an admission that the timetable belongs to hospitals and regulators now, not just Nano-X's sales deck.
Yes. And that's why I come away thinking this quarter was less about growth and more about triage. Shut the inefficient fab, add some near-term software revenue, keep the hardware dream alive, raise equity so you have time. None of that is elegant, but some of it is rational.
And maybe that's the fairest read. Not a clean turnaround, not a collapse, more like a company trying to become the version of itself it probably should have been earlier.
Right. So then the real question for the next part is, does that make the 2026 story more believable, or are investors just being asked for one more round of patience?
I think it's one more round of patience, but with a slightly better argument. The fantasy version of Nano-X is fading. Now it's, okay, can you actually become a real operating company?
Yes, and markets usually like that, in theory, then hate living through it. They kept the full year 2026 target at $35 million, but Rand Daniel was pretty blunt, quote, I don't think that they should expect a big ramp in the revenue in Q1. You may see a ramp up in the second half of 2026. So near term, they're asking investors to sit through another quiet quarter.
Which is operationally fair and emotionally kind of brutal, because the stock doesn't really get to run on vibes anymore. It needs timestamps, installs, proof.
And cash. $60 million sounds okay until you remember part of that cushion came from selling stock. So the runway is there, not infinite, not comfortable enough to miss milestones casually.
That's the tell next quarter then. Not some miracle revenue pop, but whether the boring frictions start easing. Are sites actually moving? Is adjunctive use progressing? Does Vaso keep adding useful revenue while the hardware side catches up?
Right. If those pieces line up, this quarter may look like the expensive reset they needed. If they don't, that $35 million target starts to feel less like guidance and more like hope with PowerPoint.
And the CFO transition matters more than people think. A new finance chief walking into a medtech story in mid-2026 is not exactly a gentle onboarding.
No, that's being handed the map halfway through the storm. But credit where it's due, the company sounds a little less enchanted with itself now. That is progress.
Slightly less enchanted, still ambitious. Honestly, that's probably the healthiest version of this story so far.
Fair. All right, let's leave it there. Thanks for listening.
Thanks for hanging out with us. See ya.
If you want these earnings chats to just show up, you can follow the show. And just so we're clear, this episode was put together with AI using the company's filings and the earnings call transcript as source material. So if you've got thoughts or a ticker you want us to dig into, send it to earningsunscripted@datamadness.ca, and there's an X link in the show notes too. All right, take care.